completing the audit, it must be compliant with the accounting standard. It must be considered whether the information presented and the accounting policy. Audit process consists of 4 stages, which are planning, fieldwork, audit report, and audit follow-up. In the completion of audit procedure, there are 6 steps. First is the review post-balance sheet events that occur between the balance sheet dates and the dates on which the financial statements are authorized date to issue are called post-balance sheet. Second step is review financial statement. Auditor shall review financial statement in a manner he is able to give reasonable basis of his opinion on the financial statement. Third is obtain letter of representation, which confirm the various presentations made by management in the respective manner which are material for which auditor has not been to obtain sufficient independent evidence. Fourth, send letter to management, pointing out the areas where the insufficiencies were observed in the suggested constructive advice for improvement in the financial statement. Fifth, forward point for consideration at subsequent audit. All unsettled points have to be taken up in the next period and settled with the client at the start of the next audit. 6. This is summary record of error. Auditor shall prepare a summary of all such errors and omissions which have been observed during the course of audit which have remained unadjusted.
Post-balance sheet event, also known as subsequent event. First, let us draw a timeline so that we can visualize it. The year end is 31st December, and here is the annual financial statement is being released or issued on the 15th May. During this time is known as post-balance sheet event or subsequent event, which means there is something happened after the year end. Let's say, during the subsequent event, we found out some invoices not yet been processed and we need to put it through, and it also material. Here, we either recognize it as adjusting event or non-adjusting event. For the first type of subsequent event, which is adjusting event, is known as event exists at balance sheet date. For example, on the 5th October, we sell our product to customer, and this will eventually, we will debit our account receivable and credit our sale. However, on 31st December, we found out the customer went bankrupt. Okay, this event happened after balance sheet date, which is a confirmation existence of loss at balance sheet date on a trade receivable. Therefore, we need to credit the account receivable amount and put it into bad debt account. Hence, the entity need to adjust. The next type of subsequent event is non-adjusting event. Non-adjusting event exists after the balance sheet date, which during the subsequent event there was a fire occur at the warehouse. Thus, we need to disclose it in the notes to the account. Okay, now we will discuss about the contingent liabilities and the commitment. What is contingent liabilities? Contingent liabilities is a potential future obligation to an outside party for an unknown amount arising from activities that have already taken place. In contingent liabilities, there are 2 types of contingent liability. First, which is possible obligation. Possible obligation arises from past event and existence will be confirmed by some uncertain future events which not within company control. And for the second obligation is present obligation arises from past event but outflow of economic benefit is just possible, so less than 50% probable, or amount cannot be reliably measurable. Commitment. Commitment is agreement to commit the entity to a set of fixed conditions in the future, regardless of what happens to profit or the economy as a whole. Commitment is often entered into long-term contractual to acquire property, plant and equipment, to purchase raw material at fixed price, or sell product at fixed price. Thus, such commitments are disclosed in the notes to the financial statements. As for audit procedures for commitment, first, inquiry from management. For example, the auditor may require to ask the company about their commitment and obtain letter of representation. And for the second one is documentation. For example, the auditor need to read minutes of meeting of director, committees, and general meetings.
Next is going concept. AI570 assess the risk of going concern problems at the planning stage and again during the final review. Going concern concept is about business entity will continue to operate in the foreseeable future. It is an assumption underlying the preparations of financial statement on a going concern basis. It is continued as a going concern for a future period, which is the reasonable future period is 12 months after year end. Next is going concern assessment. Under going concern assessment, there are indications of going concerns problem, management plan to mitigate going concern problem, and substantial doubt about management plan. Here are procedures if going concern are doubt. The auditor should first review management plan for future action based on its going concern assessment. Next, they should seek written representation from management regarding its plan for future action. Then, they should gather sufficient appropriate audit evidence to confirm whether or not a material uncertainty exists. So, how to confirm whether or not a material uncertainty exists? They should carry out procedure considered necessary. Next is mitigation factor. It is the factors or situation where auditor can satisfy with, for example, for the indication liability exceed asset may be mitigated by management plan to maintain adequate cash by disposal of asset, rescheduling the loan, and confirmation for financial support. While for the indication loss of principal may be mitigated by availability of source of supply, so the availability of stock enable the company to still in operation at least in the next 12 months. Then, here are audit procedure for management mitigation plan. It is consists of three types of evidence. First is inquiry from the management and obtain letter of representation. Second type of evidence is documentation. For example, read minutes of director or committee meetings or general meeting. Review contract, loan agreement, correspondence, noted any violation. Then analyze cash flow, and then analyze latest interim financial statement. The third type of evidence is confirmation. As for loan, they should ask arrangement for financial support from bank or third party. And for litigation, they should ask legal counsel for assessment of outcome and financial implication. And for amount due from holding company, they should obtain letter of comfort from holding company. Here are the example, how is it going concern and how is it not going concern. Let us look at the first one. It is going concern. In the early 2000s, General Motors was experiencing great financial difficulty and was ready to declare bankruptcy and close operations all over the world. The federal government stepped in and gave General Motors a bailout as well as a guarantee. In normal circumstances, General Motors will not be considered a going concern, but since the federal government stepped in, we have no reason to believe that General Motors will cease to operate. But for the second one, it is not going concern. Assume Microsoft is currently suing a small tech company for copyright violation over its software package. Since this software package is the only operation the small tech company does, losing this lawsuit will be detrimental. There is a 95% expectation that Microsoft will win the lawsuit. The small tech company is not a going concern because it is probable they will be out of business after the lawsuit is settled. So, we move on to audit of accounting estimate. AI 540 state auditor should obtain audit evidence regarding accounting estimate. Accounting estimate means allowance to reduce inventory and receivable to their estimate realizable value, depreciation or amortization, accrued revenue, deferred tax, provision for loss from lawsuit, and provision to meet warranty claim. It is also a management responsibility, sometimes simple and sometimes complex. For example, accruing rental expenses is simple compared estimating a provision for slow-moving inventory. Under accounting estimate, there are several audit procedures. First, they have to review and testing the process used by the management. Second, they should evaluate the data and consider of assumption used. For example, estimating account receivable, review aging and consider the accounting policy for the full debt, and specific provision or general. Third, they should testing the calculation. And for the last one, they should compare the estimate of current period to last period. Next is review subsequent event. Review subsequent event provide audit evidence regarding the accounting estimate made by management. For example, bankrupt of a customer and inventory damage caused by fire. This is the example for period covered by subsequent event review. As we can see, 31st December 2004 is client ending balance sheet date and 11 March 2005 is audit report date, and as for 26th of March 2005 is that client issue financial statement. Starting from 31st December 2004 until 11 March 2005, it is period to which review for subsequent event applies. And starting from 11 March 2005 until 26 March 2005, it is the period for processing the financial statement. But starting from 26 March 2005, it is period in which subsequent discovery of facts is made.
Next, we'll present on the related parties transactions. Related parties transaction is the person who have the connections with the firm that being audited. It is transaction made between related parties either with or without the payment. Related party transaction is also referring to transfer of resources or services or obligation. There are three important of related party transactions. The first one is to identify the previous undisclosed related party transactions. The second one is substantial related party transactions outside the normal course of the business. And the last one is the declaration that related parties transactions are at amount length. We will move on to the management's and auditors' responsibilities. For the management responsibility is, their responsibility is to consider the impact events occur after the end year of the financial statement. There are two types of events. The first one is adjusting events. For the adjusting events, it is exists at the year end that provide evidence. The management needs to consider such evidence for the disclosure of the financial statement. For example, the bankruptcy of a customer after the reporting debt that confirmed that an allowance is required against an outstanding balance at the reporting date. The second event is the non-adjusting events. The non-adjusting events appear after the year end which related to the next financial statement period. These events have to be checked in order to know the materiality. If the materiality affect the business, the management needs to disclose them in the financial statement. The example of non-adjusting event is the major purchases and the disposal of the assets. Next, we will proceed on the auditor's responsibilities. Their responsibility is depend on the period, which is consists of up to dates of the audit report, and the second one is the between the date of the auditor reports and publishing the accounts. For the period up to date of the audit reports, the auditors need to perform the procedures to identify the events that needs to be adjusted or disclosed in the financial statement. The second period is between the date of the audit reports and publishing the accounts. The auditors need to identify any adjustment or disclosures that need to be made in the financial statement, and they need to take any appropriate actions to be taken.
Auditor report is a final stage in entire process. It is a written communication of audit findings to its shareholder. It may also be used by bankers and creditors. Next, I will talk about basic elements that should be in auditor report. First, report title. Second, opinion or reporting paragraph. Third, addressee. Fourth, name and signature. Fifth, date. Sixth, introductory. 7, name and address of firm, and lastly, scope paragraph. As you can see, this is a good example of auditor report. At the above, you can see it shows report title, next, addressee, and then it shows introductory, then scope of paragraph, and then the opinion, and then the name and address of the firm and the date. Okay, now we will learn about types of auditor report, which are unmodified auditor report and modified auditor report. For unmodified auditor report, it has standard and emphasis of a matter, whereas for unmodified auditor report, it has except for, disclaimer, and adverse. Okay, first we will talk about unmodified auditor report. What is standard in unmodified auditor report? It is opinion should be expressed when the auditor concludes that the financial statement gives true and fair view in accordance with the applicable financial reporting framework. Opinion is issued when following conditions have been met. First, the auditor has obtained all the information and explanation. Second, financial statement prepared according to applicable accounting standards, relevant regulations, and statutory requirements. Next, the auditor concludes that financial statements are free from material misstatements, and lastly, there are no circumstances requiring additional explanatory paragraph. For emphasis of matter, the auditor should modify the auditor's report by adding a paragraph to highlight a material matter regarding a going concern problem. Next, the auditor should consider modifying the auditor's report by adding a paragraph if there is a significant uncertainty other than a going concern problem, the resolution of which is dependent upon future events and which may affect the financial statements. A complete audit took place with satisfactory result, and financial statements present a true and fair view, but the auditor believed that it is important or required to provide additional information. For example, to emphasis of a matter, substantial doubt about going concern or other uncertainty. Okay, let's move on to modified auditor report. The existence of any one or more of the following is sufficient to require qualification of the opinion provided the materiality criteria are met. First, a limitation on the scope of the auditor's work, whether imposed by the management or caused by circumstances beyond client's control or auditor's control. For example, auditor that just newly appointed as company's auditor. Then, a disagreement with management whether on the appropriateness of accounting policies, method application and disclosure of accounting policies and failure to comply with statutory requirements. Lastly, a significant uncertainty affecting financial statements that the outcome cannot be reasonably estimated. It may be because of significant unresolved lawsuits and not be able to sell product due to changes in legislations or technology. The first thing under modified report is except for. It is the auditor concludes that the overall financial statement present a true and fair view, but with the except for opinion paragraph for the effects of the method to which the qualification relates. This qualified report be expressed because of disagreement with management, uncertainty or limitation on scope, but the effect is not so material and not pervasive as to require an adverse opinion or a disclaimer of opinion. Next, disclaimer opinion. The auditor is not able to form an opinion as to whether the financial statement presents true and fair because limitation of scope of the existence of uncertainty. For example, the auditor has inadequate knowledge about the effect on financial statements. It should be expressed when the possible effect of a limitation on scope and uncertainty is so material and pervasive that the auditor has not been able to obtain sufficient appropriate audit evidence and accordingly is unable to express an opinion on the financial statements. Lastly, adverse opinion. The auditor believes the overall financial statements so materially misstated and do not present a true and fair view. Adverse opinion should be expressed when the effect of a disagreement is so material and pervasive to the financial statements. Last but not least, key audit matters. What is key audit matters? Key audit matters is the auditor selects the matters that require most significant auditor attention in performing the audit. Key audit matters provide information on areas the auditor spent the most effort in the audit of the financial statements of the current period. Areas where the auditor spent the most effort are often difficult and complex areas in financial statement, an area involving the use of significant judgment by the directors. The Key Audit Matters section in the auditor's report provides additional information on those matters that were of most significance in the audit of the financial statements. No spread opinion on key audit matters. Key audit matters should be not seen as follows. There are nothing wrong with the financial statement. Next, there are no areas potentially giving rise to an audit qualification. And lastly, not an indicative of problems or weaknesses in the entity's internal control. That's all from us. Thank you.